Testing, testing. How's it going, guys?
Testing, testing.
How's the audio? Can you guys hear me okay? Sweet. And try to do a quick check.
Test.
How's that? Can you guys hear Travis? Sweet. What's going on? How's everybody doing? Hope y'all had a great weekend. Sweet. All right. Give us about a minute or two, guys, and we'll get rolling here. We're just getting set up, and we'll be back shortly. All right. Hey, guys. How's it going? How's everybody doing? Happy Monday. Let's just do one more quick mic check. If you guys can hear me clearly, just type a number 1 in the chat. Sweet. All right. Trav, let's do your mic too.
Mic check. How we sounding?
Cool. How's the audio, guys? Is it pretty even between the two mics? Cool. Awesome. All right. Well, I'm excited to kick this off. We've been talking about this for about a month. Travis has come on board and is going to basically be guiding you guys in the stock market, showing you what he's doing. And Travis, why don't we do this? I know, we did the class a couple of weeks ago, but for anybody that just doesn't know who you are or what your background is, you want to just, I guess, kind of lead in with that and talk about what you do and why you do it?
For sure. Yeah.
Oh, wait, actually 1 second. Let me record this. So yeah, guys, I saw a question about recording it. We are going to put this in the members area, and sometime by the end of today, you guys are going to see an extra section in the members area related to the stock market stuff. And Travis has recorded a series of like intro videos. So you guys will see those, and then we're going to update, these class recordings and any other pertinent stuff related to stocks in that section. So again, you'll see that, and I'll shoot an email with a link whenever we make that live for you guys. So I'm going to turn my mic up just a little bit. Cool. All right. So let me hit Oh, we are recording. Never mind. Okay, cool. Travis, go ahead, brother.
For sure. Yeah. Apologies to anyone who's heard this before, because I know the intro vids have a little bit longer intro. Chris and I have done a couple things in the past where I've introed myself. But for those who don't know me, I'm Travis DeVitt, and I've been investing in the public stock markets for over 15 years. I'm professionally trained. I had a finance degree from UT Austin. Worked for Goldman. I've worked for 2 different hedge funds, one of which I worked at for 7 years. Teton Capital Partners is pretty consistently listed as one of the top global long-short equity funds, having delivered over 20% annual returns net of fees and taxes for over a decade. And that fund manages about $1.5 billion today. When I started there, I think we managed about 150 million. And one of the better track records out there in hedge fund land. So I was fortunate to be a part of that and help grow that. And and then I've done a lot of investing in some other funky stuff like angel investments and some venture capital stuff we can talk about if anyone cares. But my bread and butter has been public stock markets. We've even gotten into some distressed debt deals in 2009, 2010 where it made sense. But yeah, I've done a lot of deep research and made investments in a number of different companies across a number of different global exchanges. So here to bring the perspective of someone who's been in the world of hedge fund investing and knows how the money's made.
Yeah, and the reason why I'm so excited to have Travis on board with us is there's so much information, misinformation, just BS out there when it comes to the stock market. And it's very rare that you get somebody, with Travis's expertise and his background that's just really willing to teach what he does and also kind of guide you along. And so I think it'll be really interesting to see his perspective on the markets. And again, I mean, this is a guy that has been through the whole thing from Goldman to building a pretty large hedge fund. And we're excited to have him. So Travis, how do you want to kick this off, man? What do you want to get started
I think
with?
it might be helpful just to talk a little bit broadly to begin with about what's been going on in stock markets over the last couple months. I think a lot of people have kind of noticed that there's been volatility. The markets have been down, but I want to just zero in on that a little bit tighter. 2018 was the first year that we'd seen global stock markets decline the way that they did in a number of years. And in fact, 2018 was pretty bleak across a lot of different asset classes. So it was the first year in a long time when cash was the only broad asset class to actually be up over the year. So, a lot of that really happened in the last 3 months of the year. So we saw, U.S. markets had ripped higher in 2017 on the back of the tax cuts, and then continued that through the first basically two-thirds of 2018. And then in the last 3 to 4 months of the year, the stock market sold off, and we ended up down, I believe, about 4% for the year on the S&P 500. And emerging markets actually, saw declines that were even worse, and European and Asian markets as well. So, we had pretty poor performance across global stock markets. And to me, that was fairly warranted in some respects. I mean, especially in the U.S., we had valuations getting pretty extended on a lot of technology stocks in particular. There were a lot of geopolitical concerns that had been ignored in early 2018. And so we got a nice healthy pullback. And I think today where things stand, it's pretty interesting because the market from a valuation perspective is pretty cheap. The S&P 500 in the US trades at about a 15x forward price to earnings multiple, which is, for those of you who know, the price to earnings multiple is kind of a gauge of where the index trades in relation to like the underlying fundamentals of the businesses that make up that index. And so, historically, anything at 15 times or below has been a pretty good place to buy the index over the long term for long-term returns. And when you look outside the U.S., you've actually got about a 12x forward price to earnings multiple on the major countries outside the US in aggregate. So, and certain countries, I think, Germany was trading at 10 or 11 times last week when I was looking at it. So you've got certain countries that have underperformed even more and traded even lower PEs than the aggregate. So, as far as valuation is concerned, we're at pretty reasonable levels. With that being said, there's a reason that, markets have been jittery, and part of that involves obviously the trade wars and geopolitical concerns we've got going on. But what this volatility gives us overall is a lot of opportunity in single stocks, which is where, I like to focus attention, because even when the overall indices are trading at, kind of median levels where you're like, okay, it might be interesting long-term here. There are underlying single stocks that, are off 30, 40, 50%, where I think there's a lot of opportunity. So, I'm probably fairly neutral on markets overall at the moment, but I'm pretty interested in looking at a lot of single stocks that have come off a lot. And we'll talk about some of those in a bit. Yeah.
So just to kind of, I guess, show here on the chart kind of what you're talking about. So if we look at, say the S&P 500, which is one of the most popular stock indices in the world, you can see from the highs of the fall of last year, it basically came down about 20%. And then over the past couple of weeks, we've been getting a nice little bouncy. But even if the markets are quote unquote only down 20%, like you can find a lot of tickers, individual stocks that are much more volatile. Like, I guess an example would be Apple, right? Like down 40% off of the highs. And so what do you typically look for? And I guess maybe we can explain to people a little bit about your strategy and your style and like how you approach the markets.
Yeah.
Because a lot of the folks in here are used to the crypto markets and, pretty heavily like TA based.
Yep.
Looking at charts, looking at the technicals. How would you say your style and your strategy is both similar and different from maybe what a lot of people have been doing the past couple of years?
Yeah. So, I will say my strategy is fundamentals driven. So there's sort of a broad underlying theme to everything that I do. And that is that, markets are mostly efficient, but not always efficient. And, actually, I would say to further that point, the reactions in the market are always going to overcorrect on the upside and overcorrect on the downside. And so that's what I'm looking to take advantage of. And with regard to stocks, stocks in relation to crypto, stocks do have sort of fundamental value anchors to them because, a stock is, as most of you know, a stake in the underlying business. So it's a claim on an underlying business's cash flows. Mm-hmm. And so there are ways to, and people can disagree about the assumptions about the business's future outlook, but there are ways to, basically build your assumptions into a model and come out with what you believe the stock price should be trading at.
Yeah.
So what I'm trying to do is I'm trying to find stocks who have way overcorrected on the downside where, I think the long-term outlook on that stock is good and can provide, call it a 3 to 5x upside. Or on the other side, I'm looking to short stocks that I think where all of the positive expectations are already baked in and then some. And we're seeing like euphoric, prices in the stock that we can take advantage of to short. So, really, I'm just trying to take advantage of the fact that markets like to punish stocks, too far on the downside, and they like to push them up too much on the upside when things are going well. So, just looking for those opportunities, and I'm looking for stocks that can double or better within I would call it 12 to 24 month time frame. Mm-hmm. So I don't go looking for stocks that have 10% upside over the next 6 months or over the next week. I'm looking for triple digit type returns. And granted, I don't want those triple digit returns to be like, potentially achievable in 5 or 6 years. I want them to be achievable within a reasonable time frame in the near term.
Cool. So looking for, again, not like this isn't day trading stocks. This isn't, looking, like you said, 5, 10, 15% gains. It's looking for stuff that could potentially make a very big move over like a year or so.
Yep, that's right. Cool. And if you watch the intro videos that we're posting, I'll give a little more color as to, why my strategy tends to gravitate towards this. We could talk about day trading for all day, but there's a reason that you don't really know any billionaire day traders, right? But there are a lot of, or a number of billionaire hedge fund managers who have followed kind of similar value-based or momentum-based strategies. So,
and so speaking of expectations of a portfolio, right? Because this is kind of like where in the crypto space, we've had a lot of people that have turned a little bit of money into a life-changing amount of money, right?
Yes.
Because of the explosive growth that we've had in crypto, which has been great.
Yeah.
And that's seasonal, right? Like we've talked about, especially over the past several months, how like we go through winter periods where stuff is like really boring and prices are deflating and then market sentiment turns negative.
Yeah.
And then we have, at least so far over the past 10 years, we've had several market cycles where, we see these like, 10x, 100x like growth, right?
Yep.
The stock market is obviously much more established, has a longer history. You can run a lot of like you said, fundamental models, which makes sense, which in the crypto space, like, and a few people were actually asking me about this recently, just about fundamentals related to crypto. It's very subjective and it's very difficult to really run fundamentals on these crypto projects that don't earn profits,
yep.
right? Or don't have like just a really reliable way to value those. So, I guess so when we talk about the stock market, like maybe we can talk a little bit about expectations and like what a good goal is.
Sure.
And like, maybe even I know you talk about this in the intro videos, but it might be a good idea to maybe talk a little bit about passive versus active investing and trading.
Yeah.
And then like what can somebody expect and what would be a good goal and why would somebody want to be in the stock market?
Yeah. And the intro videos really do hit on this. So I encourage everyone to go watch them. But it really comes down to compounding. In the stock market, it's unlikely that we're going to find a 10 to 100x gainer that's going to pop in 6 to 12 months. Mm-hmm. But we're also unlikely to experience like an 80% downside move, at least in the broad index. There are obviously single companies or single stocks that go to zero because they go bankrupt. But our goal is to try to avoid those, by the way. But the aim for all of this is to really compound capital at, say, above a 20% rate. And I know that doesn't sound like a lot, but I talk about compounding in the intro video. If you compound it over 20% for 10, 20 years, what you end up with is actually a multiple hundredfold return on your original investment. So you're getting that 100x return through compounding year after year at high rates of return.
Yeah. So this isn't like something where it's like, okay, let me take $5,000 and become a millionaire by the end of the year.
Right. Right. And it does depend on your risk tolerance too. If you were to take all your money and invest in one stock and that stock did really well, it was one of the top, call it 25 best performing stocks of the next 5 or 10 years, then you could achieve that. But that's just really, really difficult to do. Mm-hmm. Now, my goal is to try to identify, the ones that have the high probability of being some of the best performing stocks over the next 5 to 10 years. So we're going to go hunt for those. But, we're going to know that it's unlikely that we're going to, one, be 100% successful at doing that. And then two, I would definitely not recommend investing 100% of your assets in one stock. So our return expectations are going to come down a bit from that. But that also means our expectation of loss should be a lot lower as well by diversifying into, a few different stocks that we think, have the potential to drive those triple-digit returns.
Yeah. And so one thing that I want you guys to do after this class is definitely watch the videos that Travis put together talking about compounding and just showing like how powerful that really is. And really consistency is key, right? Like if you make 300% on a trade, that's great. But like the idea is to think more long-term, right? And like truly understand compounding, which who was it? Buffett called it the eighth wonder of the world, or
I think Einstein and Buffett. That quote has been attributed to both, and who knows if either one has actually said it.
Cool. Okay. So that's what we do. So fundamental investing, looking for, what, 1 to 300% moves, maybe,
Yep.
so that, double,
Yep.
triple, and then, have kind of a quote unquote balanced portfolio, right? Like how many positions at any given time would you say you have on average?
On average, I would say anywhere between, call it like 6 or 7 to maybe on the high end 20 or so.
Oh, wow. Okay. So
Yeah.
6 to 20 open positions at any given time.
Yeah. And in terms of, new positions that I'm opening or actively trading in a given, I would say a given year, I'm hoping to find probably 4 to 5 new ideas a year that I think are compelling enough to be, those triple digit returns, without excessive risk. But a lot of that too depends on the environment in which we're trading. Like, I think as of late December of 2018, basically, which is 2 weeks ago, I had 25 stocks in my portfolio.
Oh, wow.
Because I was finding a lot of values, and I was taking on some shorter term trades, because I thought there was going to be a significant bounce.
Mm-hmm. So that was after the 20% dump in the SPY.
Yep. And actually, it was funny. I was at my girlfriend's family's house on Christmas Eve, on the half trading day, just sitting in a room buying stocks for 2 hours. Everybody was wondering where it was.
Like, what's wrong with this guy, man? He's addicted.
Yeah, but it turned out to be, I think, really the best day to be buying stocks of probably the last year.
Nice.
So, but yeah. Do you want to dive into a little bit more into kind of what's going on in the current markets?
Yeah, man, you guide me. I'll do the screen stuff, and you can just talk and tell me what to do.
Yeah. So far, this week, and the first week of January, which was last week, the U.S. and European indices ended up about 2%. Most of that came on Friday, and we saw follow through today on Monday. So there is some optimism starting to creep back into the markets. Which is nice to see. The economic data has been pretty positive overall. There's some mixed signals. So, the non-farm payrolls number in the U.S., which is basically, a jobs report, and, that came out last week, and that was the reason that it was a very strong number, well above expectations. It was over 300,000 net new jobs created.
Travis, not to interrupt, but do you have a website where you look for news, or like how do you filter all this?
Yeah, so I have a couple different sources. It depends on, the macro data. There's a site called Trading Economics that I think is really good.
Yeah, I like that one.
So Trading Economics is good for tracking, and then a lot of the data sources themselves, like, come from like the Fed site or the Bureau of Labor in the U.S., the BLS.
Yeah.
So sometimes you have to go directly to those sites for the actual press release, the actual data.
Yeah.
And by the way, I would highly recommend you always go to the source. Like if you need to look at, for instance, even a company's like news about a company, go to their investor relations site and look up their actual press release. Because a lot of people, what they'll do is they'll get their news from an aggregator site like a CNBC or Yahoo Finance. The problem with that is there's a lot of opinion that gets inserted into those articles, and a lot of like just mixed information that gets inserted in those articles. I love to actually go to the actual press releases themselves from the source when it's possible.
Yeah.
So I'll go and look for directly to the source on a lot of the stuff. But for macro, Trading Economics is a really good place to get summary information.
So you just start by looking at the calendar and.
Yep. For individual stocks, there's a couple different places depending on the type of information I'm looking for. Unfortunately, I don't have a Bloomberg terminal anymore, but Bloomberg terminals would essentially aggregate it all for professionals.
Yeah.
But for individuals, you're gonna use a combination of sites like FinViz, Seeking Alpha, BAMSEC or Rocket Financial to get fundamentals. I have some APIs from Intrinio and what's the other company? Basically where I can pull fundamental and financial data programmatically into different spreadsheets or applications that I have.
Cool. And you're making a resource page with all this, I assume, right?
Yeah.
Cool. Yeah. So you guys will see that in the members area.
But there are a lot of good free resources. I mean, even Yahoo Finance oftentimes has some good information, although their site has gotten really overrun with spammy content and ads over the last couple of years. So when I can avoid Yahoo Finance, I do, but sometimes I go there.
Yeah, I like FinViz. I feel like this aggregates quite a bit of data.
Yeah, and especially if you pay the monthly subscription, I think it's like $25 or $30 a month.
Yeah,
FinViz is pretty nice to see aggregate data on a lot of things or look at specific charts.
and they have good screeners too, where you can.
Yeah, their screeners are pretty good. I'm checking out a new screener called Stock Rover that I'm paying for their premium product, and that looks like a pretty nice product so far.
Sweet,
but I'll have to report back on that. And then TradingView has some good stuff too for charting and some fundamental stuff.
Yeah.
So yeah, those are a few of the places.
Cool. So TradingView, FinViz, Trading Economics. That I feel like that's a pretty good place to start.
Yep.
Cool.
So yeah, going back to the economic data. So the non-farm payrolls jobs numbers in the U.S. was really strong. And the ISM index, which is what a lot of people look at for kind of forward-looking sentiment. So the ISM, Institute of Supply Management, puts out their Purchasing Managers Index for both the non-manufacturing sector and the manufacturing sector. They essentially have two different indices for that. The non-manufacturing came out today, and it showed a decelerated number. So anything above 50 essentially means that there's growth happening.
Okay.
But we were at like 60 in the fall last year, which is really strong growth in the ISM. Yeah. And or at least that's the ISM non-manufacturing. I think the ISM manufacturing was high, like mid to high 50s, but it's decelerated. So it's come down to, I think, 57 on the non-manufacturing, and I think 53 or 54 on the manufacturing side. And essentially the ISM basically goes and takes a sample from different purchasing managers at different companies and industries and interviews them and asks them questions about their outlook going forward on the economy. So it's a nice forward-looking indicator. So we're seeing decelerating growth, which is kind of expected. We've had the Fed raising rates. We've had, essentially some efforts to cool the economy from the government side. And then you've got some, things like the trade war affecting outlook as well, and geopolitical concerns affecting outlook in certain countries. So it makes sense that we're seeing decelerating economic signals. Housing obviously is weakening as well, with interest rates being higher. But when you look at the numbers, we're still seeing growth. And so the ISM numbers that came out even today showed that, yeah, we're decelerating, but we're still growing. There's a lot of people that still expect 2019 to be a growth year for earnings and a growth year for the economy, even if that growth rate is lower than what we might have wanted.
Gotcha.
And you've got the Fed softening comments. Powell was on record last week, kind of softening his comments about rate increases. And so what we have now is actually when you look at the implied probabilities of more Fed hikes in 2019, there's only like a 12% probability that we're going to get another hike. So it looks like the hikes may be done for now. So that's nice to see. MasterCard puts out a report called the Spending Pulse, which shows data on U.S. consumer spending and retail sales, and that showed really strong holiday sales. And we're going to get a lot more information too from retailers this week, probably some pre-announcements from some retailers reporting essentially what they how they performed over the holiday season and, what they expect for the year as far as retail sales go. So we'll know a lot more in the next week or two about the outlook, but so far it looks fairly benign.
So Trav, what would you say? Like, so say somebody's starting off in the stock market and, all this information can be like overwhelming, right? Can be intimidating. Like, okay, well, so we've got the Fed, we have interest rates, we have housing, we have manufacturing, all this stuff. Like, where does somebody start, and like, how important is that? And like, how does that relate to the decisions that you make in the market? And like, I guess just what other advice would you say about just the flow of information, what's important and what's not? Yeah.
The reason that I'm spending a lot of time talking about this is just because there's such a heightened focus on economic data right now in the macro environment. Like normally the macro environment, I don't pay a ton of attention to because you can psych yourself out. Because there are always signals. It's rare that we see like 100% positive signals in macro indicators. And the market often does essentially, there's a phrase climbing the wall of worry. And markets, the S&P 500 is up like 4 out of every 5 years, like historically over the last, I think 50 or 60 years.
Yeah.
So, you can watch CNBC and see all kinds of different takes and opinions and macro data and psych yourself out from buying stocks. But the truth of the matter is, like, most years you should probably be, owning stocks.
Mm-hmm.
And for me, particularly when I'm focusing on single stocks or specific stocks, a lot of times I'm buying them with a multi-year outlook, and I'm looking for stocks that they're really growing their business in ways that aren't as affected by the macro.
Mm-hmm.
Now
so would you say it makes sense then, I guess, to maybe like understand what's happening globally, but you don't let that, you don't look at like a bad like housing report and go, oh shit, I got to dump all my stocks because this report came out.
Exactly. Yeah. I need to keep an eye on the macro to understand, like, if I need to really adjust my earnings expectations for the next 3 to 4 years to account for a probable recession. In that case, I really do need to pay attention to the macro, and I need to pay attention to the macro at turning points where something really awful is happening underneath the surface with the macro economy.
Yeah.
Most years that just isn't that important. And the reason why I'm a little bit more focused on it now is there is a risk that, say, if the Fed overshoots and causes a recession, that I need to adjust my models for the next 2 to 3 years for all the companies I'm looking at. And it doesn't mean I'm not going to buy those company stocks. It just means it may change the price at which I'm going to buy those stocks a little bit.
Gotcha. Okay. So would you say it's fair to say, like, when it comes to the macroeconomics environment, like, understand but don't obsess?
Yes. And I'll say this too. We have this memory of the financial crisis in 2008. And everybody thinks that the next recession is going to look like 2008. And I just don't believe that's the case. 2008 was a very special moment in time when our banking system was over-levered and undercapitalized and had been taking on a lot of balance sheet risks. And that caused the blow up in the financial sector, obviously caused multiple major financial institutions to get taken out. And so that's a really unusual situation, though. We most recessions, you don't have a banking crisis. And so I do think eventually over the next 10 years, it's likely we will see another slowdown, another recession, but I don't think it's going to look like 2008. And so I want to calibrate my thinking and maybe others' thinking on what to expect when the next recession does come down the pipe. Yeah,
because recessions are inevitable, right? But like there's a different set of circumstances for each one, right?
Yep.
So they look different. Like, the 1987, like, I don't even call that like a recession. It was like a V bottom bounce, right? Like, you can have down times in the market, and you can have recessions. That doesn't mean that the world is going to hell in a handbasket.
Right. Yeah. Agreed. And, actually, in certain recessions, like in 2000 to 2002, the fund that I worked for, I wasn't at the fund at the time, but the fund had actually just gotten started, but they actually made money in those years. And the reason is because there tends to be a lot of opportunity when the market does go down. It takes most stocks down with it. So one, you can profit on the short side, but two, you can also pick up potential bargains on stocks that are, the baby's being thrown out with the bathwater, so to speak.
Yeah.
Where that some stocks are getting unduly punished. And if you're able to buy them at the right time, then the stock specific events end up, creating this opportunity for you to make multiples of your money pretty quickly.
Yeah. I think it was Buffett that said, the stock market is the only place where, things go on sale and people run out of the store.
Yeah, I know. So true.
So wait a minute. So you mean buy low when people are panicking? Well, I guess, you guys in the room, that's nothing new, right? I mean, that's the idea. Short overvalued stuff, buy undervalued stuff. Very, very simple.
Yep. I noticed someone saying that, they're saying, but global debt levels are higher than in 2008. Doesn't that make it riskier? And the debt levels are only one part of the equation. When you have to also look at, total output or total GDP in relation to debt levels. And in a lot of countries, the debt service ratios, the ability to service the debt is actually a lot better than in 2008, because even though the absolute debt levels are higher, the absolute GDP levels have grown even faster. Or, for instance, with consumer balance sheets, the household debt to income ratios look a lot better than they did just prior to the 2008 crisis.
Nice.
So yeah, you do, and it's certain, especially in certain sectors like student loans and things like that. You do have a lot higher debt levels in aggregate than you did back then, but you also have a much larger economy and healthier consumer balance sheets in aggregate.
Gotcha. Yeah. And there's going to be a lot of time for us to talk about the economy and fundamental, positions on things. Why don't we take a look at the markets now? So I saw somebody ask earlier too, are we going to be doing trade alerts and stuff like that? Do you want to talk a little bit about, I guess, what this is going to look like for the community going forward and kind of what your plans are?
Yeah. So yeah, we are going to have trade alerts. We're going to have a watch list of stocks we're actively monitoring, because what I often do is, I'm following at any given time, hopefully somewhere between 50 to 100 companies that I am looking to at some point trade if they get down to the levels that I want to trade them. And so we'll have the watch list, and I'll talk about major events happening with some of the stocks on those watch lists as they happen. And then any trades that I'm making personally, we'll definitely be alerting the community, so that if you want to follow that, you can. And cool. I think here initially to start, it's an interesting time because we and I wish that we had this call on December 24th, because I would have been like pounding the table on some buys. But I actually had one of my positions was bought out in the last week, or a buyout announcement was announced in the last week, and then another position, Roku, was up almost 25% today. on a pre-announcement about their earnings. So you want
to look at those charts and kind of talk through those ideas and what that looked like?
Yeah. But what I was going to say in relation to that is, with the rally on Friday and today, I'm a little less inclined to be pounding the table to buy certain stocks as I was, say, a week ago.
Yeah. I
think generally my near-term strategy overall is to not chase positions, especially on like large up days, because a lot of the same risks that we talked about, the geopolitical risk, especially with the trade wars, the budget, the government shutdown and the budget fights here in the U.S., as well as potentially a Mueller report coming down, could create a lot of like political uncertainty in the U.S., especially in the next couple months. There's a lot of overhang, so I'm not going to chase positions. I'm going to wait patiently for the right days to buy the stocks that I want to buy, and I'm not going to chase them on up days like today.
Yeah.
I'm also going to maintain some cash in the portfolio for new opportunities. And I'm going to try to avoid companies with too much leverage in case we do head into a mild recession. And then lastly, I'd say like I'm going to start hunting more for stocks outside the U.S. The U.S. dollar had a really strong run in 2018 as the Fed was raising rates, and other economies in Asia and Europe were actually maintaining really low rates. And what that does is when rates in the U.S. go up versus other countries, it tends to favor U.S. dollar strength. Well, now that we're pausing rate hikes, I think that the dollar strength could potentially reverse, and foreign stocks are just cheaper than U.S. stocks in aggregate. So what that means is if you're a U.S. based investor, for instance, and you go and find cheap foreign stocks and you buy them, and then the dollar depreciates, you actually get a second tailwind by owning foreign stocks in foreign currencies.
Nice. So, I was noticing like the emerging markets ETFs and the foreign ETFs have gotten really beat. So yeah, I'm excited for that as well.
Yep. So I think today I'll probably introduce some of the stocks on my watch list, but I don't think I'm issuing any buy pronouncements today. Mm-hmm. Although I think, if y'all want to take a look at some of these and you decide that you want them in your portfolio, I think most of them are still at pretty good values. But yeah, I'm kind of waiting again for some pullbacks on a lot of these.
Yeah, because we had a nice little 10% bounce in U.S. stocks.
Yep.
So it seems like kind of the past couple of weeks have been nice. And, being on kind of the backside of a 20% dump in equities, that's usually followed by like some volatility. So
yep.
I definitely think there's going to be a lot of opportunity this year.
Yep.
Cool. All right, which ones do you want to take a look at?
Yeah. So, I just had mentioned the ones that have already, the two that unfortunately
That popped recently?
that popped.
Yeah.
Yes. So Celgene was a
What's the ticker?
CELG, and there was a Celgene was Bristol Myers announced that they were going to acquire Celgene in the last week, and for a combination of cash, stock, and then something called a CVR, or contingent value right, which we don't really need to get into. But
Yeah.
essentially the value of that deal is just over $100 a share for Celgene. Now, Celgene was one that I was buying kind of on the way from 80, and I think all the way down to like the high 60s over the last month.
Okay.
And, it was trading at, I think, 6 times forward earnings, which is a really, really cheap multiple. It's a biotech. They have... there's some risk that their lead drug, Revlimid, it's gonna come off patent in a couple years, and so investors were starting to worry about how they're going to plug that revenue hole. But Celgene has quite a few partnerships with a number of other biotech companies that are developing drugs, as well as a pretty robust pipeline of drugs in development themselves. Could easily do $12 or even $15 in earnings per share over the next several years. So a very cheap stock. Bristol Myers is getting a pretty good deal on a pretty cheap stock, pretty good pipeline. That unfortunately, there is actually still some upside. It's trading at a discount to the takeover price, but that's partially because part of the value of the takeover is in Bristol Myers stock. And so, it's not, the acquisition won't close for probably 6 to 8 months or so. And there's some risk that if Bristol Myers stock declines, and the value of the overall acquisition consideration can decline. But
so is this one that you're going to hold for a while then, or?
I probably will hold it. And because I'm fairly bullish on the deal closing and the total consideration being worth over $100 a share. I think it trades at 87 or 88 today.
Yeah.
So I'll hold that and get that remaining, call it $12 or $14 of upside. If I hadn't already bought it, I might not, but for now I'm just going to hold. And
cool. Cause you have a pretty good average.
Yeah. You could, some merger arbitrage funds might buy the Celgene stock, short out the Bristol Myers, and hope to capture that, $12 to $14 upside.
Yeah.
But, sort of not my game. But yeah, and Eli Lilly also announced a big acquisition today of another pharma company called Loxo at a 68% premium. So we're starting to see more deals in the healthcare and biotech space. Biotech was pretty beaten up. There are some interesting plays in biotech. And you've got the JP Morgan Healthcare Conference happening this week, which is like the conference in healthcare, or one of the big ones at least. So you'll see some announcements probably on partnerships out of some pharma and biotech companies this week, and that'll drive some pharma and biotech stocks up.
Cool.
There is one pharma development company that I own, ticker symbol MEIP, MEI Pharma. Now, this is an unusual one in terms of its like risk reward.
Woo.
This is a stock that I think could be a 5 to 10 bagger over the next 2 to 3 years.
Nice.
But it could, because it is a small development biotech, could also essentially go bankrupt. Now, I don't think bankruptcy is a likely scenario anytime in the near term. But again, I do think it's one of those where you have to size the position accordingly, because it is one that if the thesis, something happens with their thesis and, their major drug candidates show negative data in phase 3, and then they need to raise capital at lower prices, you could see a death spiral with the stock.
So basically, like with pharma companies, my experience is limited. Like I just used to day trade the momentum. Like, so you're basically looking at this as like a dumpster fire, buy, like super, super low, potential 5-bagger or bankrupt, right?
Well, so here's the interesting thing. I don't think this is like a dumpster fire company or stock.
Yeah.
I just want to make it known that with any development biotech like this, your downside scenario should be 100% downside.
Yeah. So you size it accordingly.
Yeah.
It's just like a shitcoin chart.
But what's interesting about MEI Pharma is that I have seen some scenarios. There are some scenarios out there where this could be like a $30 stock.
Oh, wow.
More likely, it's probably going to end up, if things go well for them, being a $15 to $20 stock. But again, they have several drug candidates that are in phase 2 or early phase 3, which is unusual for a company that small to see. They have some Procinostat is like their kind of lead drug candidate right now, and I think by 2020 they should have pretty good data to show to get approval.
Cool.
Phase 2 looked pretty good, and you have to look at it like there's sort of the way that you price these things is to look at a probability weighting, but if all goes right with Procinostat, that probably adds $10 a share, and then you've got a couple other drug candidates in their pipeline that could be worth several dollars a share themselves as well. So you've got potential upside into the $20 or $30 per share on the upside.
Nice. But
likely one or two of their drug candidates won't pan out. Hopefully at least one or two of them do. And again, Procinostat showing pretty good data so far, but small patient counts in terms of the trial so far. So
yeah. So Trav, how do you find these deals? Like, how do you find ones that you think are potential buys or potential shorts? And then I guess maybe help everybody understand what the flow is of your thought process and what kind of work you do on each stock on your watch list. And that way when people see the watch list, they kind of know how that came to be and what your thought process is.
Yeah. Well, I'd say this, there's not a single formula, especially in terms of idea generation. Ideas come from a lot of different places. Mm-hmm. I go in depth, we've talked about, I'm building the boot camp course, and I do go in depth on probably 6 or 8 significant areas where I do really focus to generate ideas. But honestly, ideas can come from a lot of different places. In the case of MEI, it's actually another fund manager that I know who got me interested. He is, a fairly astute biotech investor. He had spent a lot of time with the management team of this company. He's been involved for several years, and he got me interested in it. Normally, I don't play a lot of development biotechs, but he alerted me to the fact that they were so undervalued relative to the potential of their pipeline that the risk reward just became almost too overwhelming to ignore. So especially, and I've watched the stock, and it has kind of traded between $2 and $4 for about the last year or so. Mm-hmm. So when I see biotech as a sector tanking and taking MEI with it, and you have the opportunity to buy it in the low $2 range, your risk reward, really really is what goes back to what I was talking about earlier when, the stock's on my watch list because someone smart that I know owns it and really thinks it has blockbuster potential, but I wait for the right buying opportunity to actually get in myself. Waiting for that 10 to 1 kind of upside to downside level.
Gotcha. So you'll look at a stock, you'll go, okay, what is this thing? What's the potential? And kind of sector rotation, right? Sectors are hot one minute and not the next, right? In 2017, a lot of companies were changing their name to ABC Blockchain Company. Yeah. And then their market cap was doubling overnight just because they added the word blockchain, right? And then, like you said, sometimes biotech, drug companies, that they'll fall out of favor and get beat to crap, and then they're undervalued. And I guess you go looking for the stocks that when that sector comes back are going to make the biggest potential moves. Yeah.
And I'm sorry, I don't know that I fully answered your question, which is where do you go looking for ideas and how does your process work? To touch on that a little bit more, in terms of places to generate ideas, sometimes that's noticing stuff in your own daily life. I call that the Peter Lynch method. Mm-hmm. So some stocks get put on my watch list because I noticed a trend in my own daily life, and that sometimes works out well. Lululemon is an example of that I talk about in the intro videos. That's a stock that I just, my girlfriend was buying tons of stuff from there for years,
dude.
But then got me interested in it, and I noticed they were expanding their menswear lines and things like that. So I started paying more attention to it. And then I dug into the financials. I looked at kind of the earnings potential of the company. So, sometimes it's just seeing a trend in your daily life. Sometimes it's, just reading different, different trade journals or reports. I follow just a lot of different news sources and things like that. I try to stay away from like trading the most highly looked at companies, like call it Apple or Tesla. Sometimes those companies do suck me in, but I actually think there's probably more opportunity in finding stocks and ideas that are not the, top, most followed stuff on CNBC.
Yeah.
And so, I look at other fund managers. I look at insider purchases when management teams are buying back their own stock. I look at, I'll find ideas just looking, kind of chaining ideas from one company to another. So if I'm looking at a company, it may own a stake in another company, or it may be a competitor of another company that I find out is publicly traded. And then that turns me on to looking at it. So, so it's really like casting a wide net in terms of idea generation. And then from there, I sort of whittle that down into a watch list based on, looking at fundamental factors. Sometimes I kick out ideas if they have too much leverage on the balance sheet, or if, they don't have enough liquidity to trade. So I take this wide net of potential ideas and I cast that down to a tighter watch list by kicking some ideas out, finding the ideas that are more compelling in terms of risk reward. And what I end up with is, hopefully usually a watch list of around 50 to 100 stocks. And then from there, to actually trade them and make them a position, they have to get to a really compelling level price wise.
Nice. Okay, great. So I saw a couple of questions about, like, can I buy these stocks from Europe? And Jose says, if I live in South America, what do I have to do to buy stocks in North America? So I have interactive brokers just kind of showing. Do you want to talk a little bit about how like brokers work in the stock market and who has access to them?
Yeah. So, most stocks are traded on like large exchanges like the New York Stock Exchange, the NASDAQ, London Stock Exchange, Australian Stock Exchange, et cetera. But you actually trade through brokers who access those exchanges for you. And so when it comes to being able to access or trade a stock, it usually depends on what your broker, the access level that your broker gives you.
Yeah.
So you brought up interactive brokers, which is probably my favorite broker, because not only do they offer some of the lowest commissions for stockbrokers, but they also offer some of the best market access. So they try to, they really have done a good job of giving investors the ability to trade on a lot of different exchanges across the world. Now, it may also matter where you're domiciled. So like if you're living in Brazil, you may not be able to open an account with certain brokers. And you may not, even if you have an account, for instance, with interactive brokers, they may not let you as a Brazilian trade on all of the markets that they would allow a US investor to trade on. So you really do have to kind of take a look at the broker specific rules for your country. But even in places like Europe, interactive brokers, while it's probably my favorite for US investors, there are other brokers depending on your country that may make more sense. In Europe, there's one called DEGIRO that offers access to a lot of European and US markets. In Australia, ComSec. I've got a list of brokers globally that not only shows kind of what country they're domiciled in, but also what level of international market access they give for an investor in that country. So
gotcha.
Yeah, I know that's confusing, but you'll just have to kind of look at the broker list and take a look and see what they offer you.
Yeah. And I guess the only difference between that and crypto is like crypto, we can in a lot of cases go directly to the exchange, which just the old school like legacy financial system, you have a broker that's kind of the middleman, and Yeah, I mean, it doesn't feel any different to me, though. I mean,
Yeah.
the account sign up process and stuff is usually pretty similar. Brokers will have like different minimum requirements. Like I think IB is 10K, if I'm not mistaken. Maybe, don't quote me on that. They might have changed that. That was a long time ago that I saw that.
Yeah.
But yeah, David says I used Giro, works well, low fees. So
Yeah.
yeah. So I think the biggest point though is like it doesn't matter where you are. Like most countries can access U.S. markets. I think that's an accurate statement, right?
Yeah, it does depend. Certain brokers in certain countries don't offer access to U.S. markets, but a good low-cost online broker in your country, usually there is an option that gives you the ability to trade U.S. stocks. U.S. stocks, trade about half the global volume of stock trades.
Mm-hmm.
So, and I'm based in the U.S., so that's why a lot of my trades often do focus on the U.S. But I do, again, like we were talking about earlier, try to go look for stocks in other markets especially because a lot of times they're more overlooked than the U.S. market.
Yeah.
Someone asked earlier about OTC stocks. I don't typically go looking at like the penny stocks or OTC stocks in general. There are some foreign stocks that trade as OTC in the US that I'll look at, like Samsung is a good example. Samsung is a massive Korean company that, you guys all know Samsung, but, they have their stock is a Korean-based company that, for US investors, the easiest way to trade Samsung stock is to actually trade the OTC Samsung stock in the US.
Yeah. So it's SSNLF, I think, OTC in the US, and then on the Korean stock exchange, it's that number.
Yeah, exactly. Yeah. For US investors, Korea, it's hard to trade those stocks that trade on the Korean exchange for various reasons, but mainly because Korea requires their requirements for trading Korean stocks are really ridiculous. You have to
really?
You have to go through like Korean mainland brokers and set up like all these, you have to jump through a ton of hoops to open up a brokerage account in Korea if you're a US based person.
Gotcha.
Yeah. But that's why you would trade the OTC version of Samsung if you were based in the US.
Yeah.
But yeah, in general, like OTC, like I don't usually mess around with penny stocks because, for a variety of reasons, which we can talk about more if you want, but I think there's enough opportunity in like listed stocks.
Yeah. Yeah. I mean, I know penny stocks are one of those markets that has been really, really hyped up. And I know a lot of the big players in the penny stock game, and I can just tell you there's a lot of front running that goes on. There's a lot of bullshit that
so much fraud.
Yeah. So much fraud. And like shorting illiquid penny stocks is really, really difficult. It's so challenging.
The bid-ask spreads eat you up, whether you're on the long or the short side.
Yeah. Yeah. And I've actually been stuck in a couple of positions where you're like, I should be able to liquidate this. And then you're just not able to. I mean, a lot of cases it's like way worse than even trading like low volume crypto.
Yeah. David asks about, how you deal with the currency change problem. Like, so this is if you invest, like if you're a US based investor investing in say European stocks, or you're a European investor investing in US stocks, you've got a currency change problem there. So it depends. It depends on your outlook on the currency that you're essentially owning. Like if I'm US based, so if I buy a European stock, I own like a euro denominated asset. So when I go to sell that, I'm going to end up with euros and I'm going to have to change back to dollars.
Yep.
So I can do one of two things. If I want exposure to the euro, I can keep that currency unhedged. So I can own the European stock and, I can benefit from the euro increase against the dollar if I believe that's what's going to happen. Or I can straight away, right at the time I make the initial investment in the stock, short a bunch of euros to cover the investment in that stock to cover the currency exposure of that investment.
Mm-hmm.
So it gets a little bit confusing I won't go too in depth on that right now, but you can hedge out your currency exposure at the time you make the trade. And you can continue to adjust that exposure with your trade over time, or you can let it run naked, depending, if you think that having an investment in that local currency makes sense for you.
Yep. Yeah. Like Harry said, I mean, it's kind of like the two-step process of like alts to BTC to fiat, kind of similar, I guess.
Yep.
Cool. All right. Do you have some other examples you want to look at, or what do you think would be a good next step?
Yeah. So I've got some single stocks we can talk about that I'm focusing on the watch list if you want.
Cool. Yeah, let's do that.
Yeah. So, while we're on the topic of foreign stocks, I can talk about a couple that I'm looking at. Samsung is actually oddly one that I'm starting to do a little bit more work on. Pretty cheap stock, trades for like, I believe about 6 to 7 times expected earnings this year.
Yeah.
Unfortunately, Samsung's always kind of traded at a single digit price to earnings multiple. So the question is like, what's going to change that? And that may be the problem, but Samsung's got the other problem with Samsung is that it's got multiple like major business units doing different things. So it's kind of a conglomerate, but obviously they've got pretty valuable IP in the, electronics and smartphone industries. They've got a pretty big DRAM and NAND memory business, which I'll talk about more, but
this chart looks terrible.
Yeah. But, when it starts to approach like the 5 to 6 times earnings level, I get fairly interested.
Yeah.
If you want to think about it like a Google or an Apple, which trade, at basically double the multiple, it seems like a relative value on that basis. And, again, I don't know what the catalyst would be. That's why I don't own it yet, but I'm poking around and I'm kind of putting it on the watch list. Because I think it's at some point going to be too cheap to ignore.
Cool.
There's a stock called Bolloré, which trades in France.
You know the ticker?
I believe it is BOLFP or just BOL if it's in France.
Oh, there we go. I think that might be it. Nope.
So this one's interesting because
how do you spell it? BOLL?
BOLLORE.
Yeah, FinBiz doesn't have that either. BOLLORE. Oh, BOL. There we go.
Yeah.
Cool.
So this is an interesting company. It's controlled by a guy, Vincent Bolloré, and his sons. He's an interesting character. So Bolloré owns a collection of assets, and it trades for what I believe is like it basically trades at about a third of what the value of its assets are today.
Oh wow.
Yeah. So it's at a pretty it's at nearly the highest discount to its like net assets that I've seen it. One of the biggest assets it owns is a huge stake in Vivendi, which is another company that's traded in Europe. So Vivendi itself owns a collection of assets. Vivendi owns, their biggest asset they own is Universal Music Group. So it's like basically one of the 3 major music labels globally. So Universal Music Group has been growing pretty nicely. Essentially, there was with the rise of streaming, a lot of the record labels' revenue is finally growing again. For a number of years, like record labels were losing money because people stopped buying CDs and music, physical music, that is. But with the rise of streaming and companies like Spotify paying royalties, the music labels have once again become really valuable. And Universal Music Group's probably the best in class. Like their roster includes like Taylor Swift and a who's who of like major artists.
Yeah.
And so that business is growing, and Vivendi is actually is going to be either spinning off or selling part of Universal Music Group, and it's reported to be the value of Universal Music Group essentially is worth the entire market cap of Vivendi. And Vivendi also owns several other major businesses like Canal, which is a pay TV company. A lot of people like to think of it as like a French or Italian like Time Warner. Like the problem with that asset is it's sort of been like slightly declining and losing subscribers over the last few years. But anyway, it's worth something. And Vivendi also owns Havas, which is like a major advertising company. And they own a 24% stake in Telecom Italia, which is one of the largest like telecom providers in Italy. And they own pieces of a couple other businesses. Anyway, so Vivendi itself is believed to be trading at a discount to its value of its assets. Now Bolloré owns a big stake in Vivendi, but it also owns like a large logistics and transport business. It owns a bunch of African ports. So that's where it really gets interesting, because if you're bullish on Africa long term, like I am, the African ports business is a business that probably grows over the next 5-10 years, and is already producing some profit for Bolloré. They also own like some U.S. farms, some African plantations, like some French wine growing vineyards. They own 8% of a major bank, Mediobanca. So Bolloré owns all these assets, and they've talked about actually selling some of their African port business, with Vivendi spinning off some of their Universal Music Group stake. They could see some cash proceeds from the Universal Music Group's sale. So essentially, Bolloré trades for like right around or just under, I think, €4 a share. And I think the value of its assets is probably closer to 15 or 20 euros a share. So it's at a compelling enough discount today where I'm considering making a purchase.
So how would you, so just to kind of recap, like whenever you look at something like this, and hopefully you guys can see this, like each stock is like its own story, right? Like, you look at it and you go, okay, this company does this, they own this. This is where I see upside potential. This is where I see risk. Once you kind of understand the story behind the stock, how do you go about planning a trade or an investment? And like, maybe we can use this as an example.
Yeah. Well, if at some level, like I'll put together financial models on a company when I get deep enough into the research that I think it's compelling, and I want to actually put a number, like a price target, on where I think the stock should trade. Again, I think you have to kind of come up with a range. I typically will do like 3 cases. I'll come up with like what I think is like a base case valuation for a stock price. Like, what should that company trade at on a per share basis? Then I'll come up with like a bull case. Okay, if everything goes right, they really hit their growth targets, et cetera. Like this is what like the stock could trade at in a like rosy scenario. That's like the bull case. And then I'll have a bear case scenario, which is like things don't pan out, competition erodes margins. Maybe, in the case of the biotech, like I talked about earlier, maybe one their drugs, don't proceed through phase trials. So there's always I'll always have the bear case valuation, like how much could the stock be down? Like what level would this stock trade at if things do not pan out? And each of those cases has a set of assumptions, but essentially what I'm trying to do is find a range for where I think that stock should trade. And then usually most of that is based around the base case. When I look at, well, what could this stock be worth? So if I think a stock is trading at $10 today, and the base case says it could be a $30 stock in 18 months, and then maybe the bull case says it could be a $50 stock in 18 months. Once it gets to that kind of triple digit return, especially like over a 3 or 4x upside to downside level, that's when I really will get involved and actually trade that stock.
Well, so I think the biggest difference that I kind of want to point out for people is like, for those of you guys that are used to looking at, technical analysis and going, here's like price support. One way that, I guess, Travis, correct me if I'm wrong, but instead of looking at the TA first, you'll look at the company and say, at this price per share, I think is a good value. And then I'll look to buy in that area.
Yep.
And then if my bull case or even the base case plays out, this is where I think the stock could get to.
Yep.
And what I like about that is like it gets you thinking of like the true value, right? Because think guys of like Ripple, right? When Ripple went from 30 cents to $3, a lot of people weren't thinking about the market cap and the value of the whole ecosystem, right? And they were just thinking, hey, this is the cheapest thing in the top 10 crypto. But really it was overvalued because of the total market cap, right? So when Travis looks at this stuff and he's looking at the revenue and their growth potential, you can use that with some pretty good accuracy, because you're looking at these prices based on real, I guess, models of like how to value a company, right? And then if you combine that maybe with some TA and you plan your risk to reward, I think that's probably the best way to approach this whole thing, right?
Yep. And, and we'll talk more over the next few months about valuation methods. And there's a lot that goes into, figuring out the assumptions and assigning, those price targets to companies. But yeah, that's the general process. And there always is a story component as well. It's not all hard numbers because again, your numbers are the output, the price per share that you think a company's worth is always requires like a set of assumptions. And part of those assumptions are, how is the company going to grow? Like, what are its product suites going to look like? What's competition going to do? How will margins be? And, some of that is, it's not going to be 100% known at any given time. And you are taking a bet a lot of times on the future outlook of that company. So part of it is a story. I can talk about Roku, which is, the other stock that I mentioned from earlier that was a company that I was buying on December 24th that I was hoping to be able to share with you guys as a potential buy. Unfortunately, it's up 25% today. So we missed it by a couple of days, but
damn. So you nailed the bottom on that one.
Yeah. I was lucky to nail the bottom. I didn't have a full position size, so I was hoping it was going to stay lower for longer. But but this was a company that, when you look at the numbers, it's growing really rapidly. It's in a field that's growing, which is streaming and over the top, which is replacing. People are cutting the cord. This is a mega trend, as you all know, like cord cutting. People giving up their $150 cable bills to instead use streaming services like Netflix, Hulu, Amazon Prime, and companies like Roku, which have essentially like a third-party operating system for cord cutters.
Yeah.
Roku allows you to, essentially an aggregator. Like it's an interface to access all these streaming services, but they also have their own channels in which they sell movie and TV content and do advertising. So Roku gets a growing amount of revenue from cord cutters. And today they announced really strong numbers. Their Q4 numbers, they saw accelerating account growth over 40%, and streaming hours were up over 60%. So it's a company whose business fundamentals are really just accelerating. And and I
bet they're a lot cheaper than Netflix.
Yeah, well, you essentially buy the Roku hardware.
Yeah,
you can buy it. You can buy a Roku stick for as cheap as like $25 or $30.
Sorry, the valuation, like because Netflix has been.
Yeah, for sure. I think at 20, kind of at that $30 level, it was around a $3 billion enterprise value for the company. And Netflix is well over $100 billion enterprise value, so the difference is pretty stark. Now, I don't think their business will ever be as large as Netflix's, but they're earlier in their international expansion. They are earlier in the trend of really monetizing than Netflix. So I think the stock is probably worth $60 in 1 to 2 years. But again,
so that's the plan, is like a move from like the 30s to the 60s.
Yeah, and so that's a perfect example of like I like that stock a lot more at $25 to $30 because you can get a double out of it.
Yeah.
Whereas if you're buying at 42, there's upside there to $60, and maybe even goes above $60 as if the fundamentals continue to outperform. But sitting here today, like if I think fair value is 60. I don't want to be chasing it at 42. I'd much rather be chasing it at 25 or 30.
Yeah. And that's what I really like about these stocks. Like even if you look at the stock chart, like a move from 30 to 60 in relative to its prior price action is nothing crazy. Like you can get a double mid trend, right? Like from a technical basis, right? Like you guys know, like if you're used to looking at crypto charts where you get these breakouts and you're sitting at all time highs, like it's really hard to come up with profit targets. But from a technical basis, you can see prior resistance here back in 17 and it's mid range. So like that is not out of the world of possibility, especially if you have the fundamental, model to kind of back up that valuation.
Yep. And there's risk here to Roku. You've got increasing competition from Amazon with the Fire stick product. And so like, there's the competition is going to evolve in a way we probably can't foresee today, which is why, even though I think it's a $60 stock fair value today, like, I don't buy it at 42 because there is risk. The downside case is there. And I need to have at least triple digit upside to justify.
Yeah. Yeah. And that's what I like about this, right? Like your philosophy is in line with like our belief about like trade less, profit more. Right? Like we're not over trading. We're not getting shaken out by little moves. Like when you, for those of you that have never like actively traded, just like take our word for like the benefit that you have of not obsessing about every little move in the market, especially if you're managing a portfolio of a dozen or two stocks, right? Like you want to have that flexibility to be able to sit back and let a trade work and not be overly precise or overly obsessed with like every little move every day. Like there's just so much freedom that comes with that. Trav, I've got a question. What would you recommend to somebody with zero exposure in stocks?
Yeah.
I think that might be a good time to, I guess, just talk a little bit about the difference between like active and passive.
Yep.
Like, because, I think and again, this isn't financial advice, but it's just my personal belief that everybody should be in the stock market just because it is the best wealth generating machine of the past 100 or so years.
Yep.
And if you're not in it, you're missing out, period. I mean, no matter what your political beliefs are, I know with crypto, like a lot of people are anti, establishment, and I get that. And I've seen the BS that comes in the public markets, but I do still participate. And I think you're leaving a lot of money on the table if you don't. So like what are the differences between passive and active and who would be right for those?
Yeah. And watch the intro videos because it really covers this in depth really well. But I'll give you a short summary here, which is, if stocks as an asset class are one of the best performing asset classes out there over like long periods of time. So, you'll get about probably somewhere between an 8 to 10% annual return over a long-term horizon. And when you compound that, that turns out to do pretty well for your portfolio. Like over 30 years, that would turn your portfolio, that would actually be like 10 times the value of your initial portfolio over a 30-year period, compounding at 8% a year. So, and it's consistently provided above inflation level return. And there are various reasons why, which we won't get into right now, but that 8% return is a good way to beat inflation over the long term. And if you're holding a long-term portfolio, you can be fairly certain that you're going to beat inflation having exposure to stocks. So that's why, as an asset class, I think it makes sense to have exposure. Now, the difference between active and passive is this: like, if you want to be passive and earn, your 8% annual return in the stock market, that is totally fine. And there are lots of great options to get that exposure. ETFs, for instance, are very low fee, low cost ways to get exposure to the stock market. And that's kind of a way to just put your money there and ignore it and just let it grow for the long term. And you don't want to be trying to time the market if that's your approach. Now, the active approach is, the attempt to actually, rather than owning the index and getting your 8% a year, it's your opportunity to try to go and earn that above 20% a year annual return by trying to pick the best performing stocks. And that's not right for everyone. But, I have pretty high confidence in my ability to do that. And so that's why I do it. And you guys have paid and you can piggyback off of me. So it's if you want to do it, you've got a pretty good outlet to do it now, right?
Yeah.
But you have to also be careful because you don't want to, again, own one stock in your portfolio or you'll get blown up eventually.
Yeah.
And there's just things you want to make sure you do if you're going to try to be an active stock market investor. So.
Yep. Yeah, I agree. I mean, so basically, if you don't want to put any time into the stock market and you just want to take whatever the average market returns are, buy some low fee index funds and forget about it and just let it sit there for the long term. If you want to get alpha, meaning juice your returns above what the market gives you, that's where active management or active investing really comes in, right?
Yeah. And the compounding it's non-linear. So if you earn 8% a year, for 30 years, you'll have 10x the value of the initial portfolio after 30 years. If you earn double that return, if you earn 16%, you end up with 8.5. You end up with was it 85x?
Yeah.
So you end up with as opposed to 10x at the end, you end up with 85x at the end.
That's exponential.
Yeah,
it's like
and
massive.
if you had a 24% return, you get at the end of 30 years, you'd have 634 times your initial portfolio value. So, that 24 versus the 8, right? Like, it doesn't sound like 24% versus 8%. You're like, oh, I get 3 times the return.
Mm-hmm.
Well, if you get 3 times that return every year for 30 years, your ending portfolio value is 634x the initial, not 10x the initial.
And I think that is that's why good hedge funds exist, right? Is alpha. Like there's a lot, like we call like mutual funds like a negative sum game, where basically after paying expensive fees, you're going to lose over time. But like if you can get with a good hedge fund or a good investor and you earn that alpha, like it's massive numbers over time.
Yeah. Someone asked about specific ETFs. I mean, I think if you're going to go the ETF route and you're going to go the passive investing route, the Vanguard and ETFs are really good. Like you can get the Vanguard, the VT or the VTI. Yeah. Depending on whether or not you want to own the US market or the world market.
Mm-hmm.
Either one of those, I think, are going to give you a pretty good shot at earning those nice, stock average annual returns, 8 to 10%, over the long term.
Yep. Yeah. And these are some that I have, like with Schwab, like we have the broad market US, we have international, which is more established markets, like I guess Japan and stuff like that. And then you have emerging markets, which is smaller countries.
Yeah. And like you mentioned earlier, Chris, I think, this presents potentially a decent time to start to, if you're going to go the passive route and put money into stock ETFs, not a bad time in terms of valuation level relative to historical. Not to say that it can't go down more from here, but historically you would have done pretty well at putting money in at these valuation levels in the ETFs.
That's good to know because,
and you don't have to put it all in at once either. You can scale in over time.
Yeah, and there's so much fear. There's so much, there's like perma bears on CNBC. It's the same thing when it comes to crypto. Like you got to be really, really selective and careful about what you listen to and whose advice you take, right? Because a lot of these gurus that were perma bears in the market, I mean, they've missed out on the biggest bull market in history. So my suggestion to you guys is just like, if you are interested in the stock market and you look at this and you go, yeah, man, this is a wealth generating machine, then do it the right way, right? Like put some time in, learn what you're doing. And if you want to go for those outsized returns, put in the work, make a decision if it's worth it. If not, there's absolutely nothing wrong with sitting back and being passive. But, again, the difference is so huge over time that's why I'm in it. That's why, Nikki spends a majority of her day looking at it. And that's why we brought Trav on, who's like, I can't think of anybody that's more qualified to teach this stuff to you guys. So
for the active crew, do y'all want me to mention a couple other stocks that are that I'm looking at for the watch list? Or are y'all tired of hearing my voice?
Cool.
All right. So there's actually a couple of categories that I'm looking at right now. Chinese stocks that trade in the US, I think, are pretty interesting. I'm a little bit worried about the Chinese macro environment, but that being said, like that's why these stocks are on my watch list. I'm not like pounding the table to buy right at the moment, but these stocks are down a lot. So Baidu is one of them. Baidu is the Google of China. BIDU is the ticker. Trades for about 20 times earnings, which is a historically pretty cheap multiple to buy Baidu at, as it grows like 20 to 30% a year.
Yeah,
they're really strong in AI. They're getting into autonomous driving. They have Dware OS, which is like their version of Amazon's Alexa, which is now installed on like 200 million devices. I mean, the thing about the Chinese market, it's a market of 1 billion consumers and growing, and it's just it's very unusual to see like even large foreign tech companies go in there and compete successfully. Like Google has tried to go in there and compete against Baidu several times and has lost. And Google employees, essentially, this didn't really get noticed at the end of the year because of the volatility, but Google is essentially killing their entry into the Chinese search market again because their employees were like, we don't want to be part of building a search engine for the Chinese market because of the Chinese government, which censors a lot of search results. And so Baidu has got the largest market share of the Chinese search market. They also have a large stake in Iqiyi, which actually is a publicly traded company now as well, ticker symbol IQ. IQ is worth about $12 billion today in market cap. They're burning cash. So IQ is
this the right one?
Let me look. Yes. So IPO'd at about $18 a share. So you can actually buy it a little bit below where it IPO'd.
Hey, get into the pre-ICO price.
IQ, I don't love the idea of owning IQ outright because the cash burn is so high. I'm kind of worried about where they're going to get capital to fund their losses for the next several years, but others may disagree with me on that. IQ is looked at as like the Netflix of China.
Oh, okay.
They have something like, I want to say it's like 50 million paid subscribers now and several hundred million like free subscribers, which are crazy numbers because like they're essentially like the same levels as Netflix in just being in China. Like that's how large the Chinese market is.
Yeah. Now
they monetize less because they charge the equivalent of like, I think $3 a month for their premium service. Because Chinese consumers have about a quarter of the purchasing power that US do, so prices are lower there. Anyway, so IQ is burning a lot of cash, but Baidu earns a large stake in them, and then you've got Baidu, their core search business, continues to have a really strong market position. The stock isn't really expensive in terms of price to earnings, so Baidu is pretty interesting to me. I would really like to, if we can get it to gap down a little bit on just Chinese macro economy weakness, I think I would get potentially into the stock.
Nice.
But
so are you more focused on like Chinese macro, or is there some kind of like valuation that you think would be a super good buy? Or
well, I actually need to do a little bit more work on Baidu to determine my official price targets. That's part of it.
Cool.
But I do think too, from a trading opportunity standpoint, the Chinese macro, like the Chinese PMIs are below 50, which means the Chinese market outlook is pretty bad.
Yeah.
And
their housing situation is really sketchy too, right?
Yeah. There's a lot of sketchiness around the Chinese economy and the way that's been fueled by debt and things like that. And the capital allocation, a lot of these Chinese tech companies is a little bit questionable too. So, if there's an opportunity to pick up Baidu at like, say, like a sub-market multiple, like if it drops another 20% or 30% this year on Chinese macro weakness, that might be an interesting time to buy. But again, I also need to kind of establish my price range a little bit better as well before I get involved. But it's one of them watching.
Gotcha.
And just from a competitive standpoint, it's a company that you really have to like in terms of its business model. It's the Google of China, and it has the largest market share of search. There is some risk of market share loss in mobile to a company called Shinma, but Shinma's market share gains have flatlined over the last few quarters. So that, again, it's something I need to look deeper into, but on the surface doesn't seem too awful.
Cool.
Ctrip is one that it's another Chinese stock, CTRP. It's the Expedia of China, or the booking of China, if you want to look at it like that. Nice. They allow Chinese travelers to book flights, hotels, vacation packages. Has taken a massive hit. Their guidance for the next quarter really underwhelmed investors, and so the stock got hammered. In addition to just general China weakness, taking that stock down as well. It's the cheapest valuation it's had in I think since the financial crisis.
Wow.
So it's growing, like its hotels business, its package tours, and its corporate travel business, all somewhere between the range of 20 to 30%, and that's what you want to see. They also have stakes in a lot of other Chinese businesses, mostly related to travel. Elong, they own part of China Eastern Airlines. They own part of a hotel company called BTG Hotels. They own a stake in Make My Trip, which is the largest Indian travel booking company. And so in the last few years, they've acquired stakes or acquired outright Skyscanner, which is like the kayak of Europe, Trip.com, Qunar, which was a Chinese competitor. They have a stake in Tujia, which is like the Airbnb of China.
Oh, wow.
So this is essentially like the travel company of China. I mean, this is the company you want to own to have exposure to Chinese travel, which China is expected to become the #1 market for travel globally, over the next decade. And, there's massive long-term tailwinds in terms of piggybacking off the income growth in China. And as travel becomes more common with the Chinese, I think it's something like only 10 or 15% of the Chinese travel outside the country right now. So that has a lot of room to grow. And this is a company that I've long wanted to own. I actually do own a little bit of it now, bought in the mid-20s after it came off in the last month.
Nice.
But again, I don't want to chase it too aggressively here because of potential macro headwinds in China. But this is one that I'm going to look to accumulate if it sells off some more.
And this could be maybe a multi-year hold, do you think? Or?
Yeah. I think this could be a potential compounder that could be a 3 to 5x over a 5-year time frame.
Nice.
Yeah.
Maybe similar to the old school Priceline trade you guys had.
Yeah. Oh God. Yeah. That was a.
Are they? They're under booking now, right?
Yeah.
Is it
BKNG?
BKNG. Okay.
Yeah.
You want to tell people this is kind of an interesting story about how you never know how far trends can go, right?
Yeah. So this is a perfect example too of a company that I'd long admired, that I'd had on my watch list, and then when the financial crisis hit, I think the stock went down over 50%. And
does it mirror this, the old Priceline chart? Because it's not around anymore, right?
Yeah, no. Well,
yeah,
they just changed their name. It's the same company, so it should be the same chart.
Oh, okay.
Yeah.
Okay, cool.
Yeah, I'll tell you why they changed their name here in a minute. So Priceline had one of the best, they were long known as their first business was Priceline.com. You remember the old William Shatner commercials. They essentially mostly were a place for you to get discounted airline or hotel bookings. And you could do the name your own price thing.
Yeah.
But in the early 2000s, they bought a company called Booking.com, which was the largest hotel, or became the largest hotel booking site in Europe. And, at the time when they bought it, it wasn't a huge business, but it became much bigger even than their core Priceline.com business, because the economics of hotel booking in Europe were really, really good. You could get they essentially got really high fees on hotel bookings. And the European hotel market was very fragmented. So there weren't major hotel chains that owned all the hotels. So they could, once they aggregated all the hotels in Europe, they were the only player that you could go to a website and book a hotel in a random European town, So
Gotcha.
Anyway, the short story of this is this was a company that I had really started to admire. Their financials had been improving. They had a great management team. Jeff Boyd, their former CEO, was just brilliant. And, but it never traded at a cheap enough price where I wanted to own it until the financial crisis. And in the financial crisis, the stock went from over $100 to about $50 a share. We bought right around the bottom, around 50. I think it was $50 or $55 a share. I don't know if this chart is reflecting those prices or if
yeah. So this shows going into 2008, topped out around 140. Then slammed back right below $50.
Yeah, so we bought it, I think, average cost of $52 during the crisis. And this turned out to be one of the best buys I ever made, but also one of the biggest mistakes I ever made. It still kills me because this stock went from $50 a share to about $2,000 a share over a decade. It was one of the best performers in the U.S. stock market over 10 years. And you had the potential to make, 20, 30 times your money. And we sold it, however, at, I think around $140, $150. So we made almost a triple on it. But we we sold it too early.
What do you guys think you underestimated, or what happened?
We underestimated how long Booking.com's growth runway was. So like similar to the way I'm thinking about C-Trip today, we were like, we knew that the long-term growth potential of Booking was huge because they were not only just crushing it with European travel, but they were starting to expand into other markets like Latin America. They were bringing the Booking.com platform to America. But the company was getting pretty big, and it's unusual to see a company grow at like over 40 or 50% for like 5, 6, 7 years. But that's what they were doing. And in fact, their growth rates actually accelerated coming out of the recession. I think the other part of that too was we underestimated how quickly the recovery was going to be coming out of the recession. And so, yeah, we should have left a runner position. That was something that we learned. Well, something I learned. But
you guys took this at the fund too, right?
Yeah.
So the fund and your personal account.
Yep. And so this could have been, the greatest stock I ever owned. It was a nice triple, but left a ton of money on the table. And
so that's a good lesson though, right? Like even if you're right, you can underestimate, you can overestimate. Like trading and investing isn't a game of perfection. It's a game of taking bets and making hypotheses. And, sometimes you're right, sometimes you're wrong, sometimes you're right. And you way underestimate how right you really were.
Yep. Yeah. With C-Trip, I'm going to try to not make this mistake. Again, it may take longer than Priceline did, but I think the tailwinds, longer term tailwinds are there for this company if they don't screw it up. You get a lot of tailwinds, not only from them, if you think about it like this, hotel prices in China will increase over time. The number of consumers booking hotels will increase over time. The other ancillary products that they offer will increase over time, like the things to do and the other parts of packages like car rentals and things like that. So there's all these levers of growth for these guys to pull. So even as you see growth maybe declining in the short term from 30% revenue growth to 20% revenue growth, I think when you look over like a 5 to 10 year time frame for this company, they should be able to grow revenue at like some average compounded rate of like 25 to 30% a year for like many years.
Extended.
Which is what I underestimated at Booking. And I'm trying not to underestimate here.
And then if you get the Chinese government behind it, right, that's like, I guess one of the pros and cons of having a government like that is like, if they have their hands in this, they're gonna make sure it succeeds as well.
Yep.
Okay, cool. So Vinny asks, have you heard of NIO, the Chinese Tesla?
Yeah. So NIO, I have looked at. It's too speculative for me right now. Like I'd like to see them, produce something before they're kind of more of a concept stock at this point. I know they've got the capital and the backing from people that you want to see. Like even Tencent. Tencent was actually another one of the Chinese stocks that I could talk about today, but maybe we don't want to keep going on. But Tencent is on my watch list as well. But
nice.
Yeah, but Tencent and others, obviously NIO went public in the US as well to raise some capital. So they, have often been referred to as like the Tesla of China. I'm not convinced on NIO yet. I do need to do some more work on it, but China already has a bunch of EV manufacturers. Like BYD was a company that Buffett invested in like, I think 8 or 10 years ago. And, they have expertise in electric vehicles. And the Chinese EV market is obviously going to be huge, but NIO hasn't really proven that they can produce cars profitably yet. So, or at scale yet. So they've got the capital to get it started, but I'm not ready to make a bet on NIO, especially when other companies in the auto sector trade at like super, super low multiples. So.
Gotcha. Another question: do you get dividends from these stocks? Like, how I know there's different strategies of like.
Yeah, I don't try to optimize for dividend stocks. I like it when a stock I own that I think has a lot of upside potential pays a dividend because I get a little bit of income on the side. But I don't optimize for it. And there's several reasons for that. But, a lot of companies have really reduced their dividend payout levels because, they can buy back stock or they can reinvest in their business for growth. And those tend to be a little bit more, they offer other advantages that dividends don't.
Yeah.
We could go real deep into that topic, but I prefer companies usually to not pay dividends. They should either be buying back stock if their stock is cheap, or they should be reinvesting for growth if there are growth opportunities.
Yeah. Yeah. Now, so like the way I've always thought about it is like higher growth, like tech, typically not a dividend. Blue chip, old school companies will offer a dividend. Yeah. That kind of the baseline. Cool. All right. So we've been going for almost 2 hours now. I know we've been kind of just rifling through a whole bunch of stuff. If you guys have any other questions, feel free to throw them in there. Travis, was there anything else that you wanted to cover today, or any other points, or kind of getting started stuff? I know we're just kind of organizing all this and getting it rolling.
Yeah, I mean, I think we covered most of the high level stuff. There's more single stock stuff I could talk about related to the watch list. But I want to be mindful of people's time.
Why don't we do this? So here's what's going to happen, guys. This week, or actually today, I'm going to send an email along with the recording of this. And when you guys log into the members area, you're going to see a section called the stock community. And Travis has done about a half dozen or a dozen kind of starting videos, kind of showing you guys all the data that he kind of talked about earlier, but also talking about the options that you have when it comes to the stock market. So definitely watch those. And then over the next week or two, Trav's going to be building your watch list and stuff like that. Is there anything else you wanted to mention about any of that?
No, I think you covered it.
Okay.
I mentioned my near-term strategy for like investing and trading. I guess I could reiterate that as, again, I'm trying to right now just be really, really patient in this market. I think there's a lot, even this week, there's a lot going on with US and China trade talks today and Tuesday. There's, government shutdown and budget issues. There's Fed minutes are being released on Wednesday, CPI data released on Friday in the US. There's a lot of retailers like Bed Bath & Beyond, I think, reports their initial earnings. There's just a lot of stuff happening this week, and just a lot of stuff happening in general right now around the economic picture. So just, again, I think I'd encourage everyone to just really be patient. Don't chase, but realize that there are, good opportunities right now in the market.
Yeah. Oh, and we're going to be rolling out some channels in Discord related to stocks. So I'll send an announcement. We're just going to be kind of organizing sections. So we're going to have obviously the crypto section. We're going to have some stock channels. We're going to have some personal finance and kind of like finance hacking channels, showing you guys just different tools and resources that we find. And then next week, Nikki's going to be rolling out kind of a foundational course based around personal finance. So you guys will see that in the members area as well. So over the next like 3 to 4 weeks, we're going to be rolling out a bunch of stuff. And hopefully you guys got a lot of value out of this. I know I just could geek out on this stuff forever. And again, Travis is like the smartest guy I know at this. So I'm excited to see what happens over the next coming months. And just looking forward to having a big year, man.
Yeah. And I'd love to talk more about the watch list stocks, especially next week during our weekly update, because there were a lot of them that I didn't get to. Mm-hmm. Like I talked about the Chinese ones, which are kind of a funny little sector of stocks that I'm watching, but not the ones that I'm even particularly, other than T-Trip, probably not like the most bullish on. Like there's probably other stuff I'm actually more interested in.
Do you want to do like a rapid fire, like run through some of those?
If y'all want to.
Yeah. Let's go for it.
I mean, the focus is trying to find stocks that don't have super levered balance sheets, but that are like trading pretty cheaply. And I think a couple of those would be, Huntsman, which is a chemicals company. They, the chairman and CEO bought some stock around $19. It's only up a little bit from that.
Okay.
Over the last week, it trades at like 6 times forward earnings. It's only got like 1 times net debt to EBITDA, which is pretty reasonable like leverage. So if we get a recovery in the market and macroeconomic fears ease this year, that stock could probably be up 50 to 100% over the next 12 months.
Oh, nice. So you think this could be a candidate for a breakout to an all-time high?
Yep. But again, I'm being patient. I don't want to chase it. So that's one that I think is pretty cheap. It's not going to give you like 500% upside potential, but it's one that I think is a nice stalwart in the portfolio.
Yeah.
Eagle Materials is another one. EXP is the ticker, US stock that meets the criteria. This is a business that I've long followed and just really been a fan of. The management team is super sharp here. Trades at about 12 times earnings, maybe closer to 10 times 2-year, earnings that are 2 years out.
Mm-hmm.
So relatively reasonable price for a business that's really, really well managed. They're in a couple different businesses, cement being their biggest business line, really good business protected by, like, they have the lowest cost in the industry, lowest production cost in the industry, regional monopolies in cement production. You just can't transport cement over long distances and make it economical. So they control really strong cement producing positions in like really good regions like the Southeast and in Texas and places like that.
Gotcha.
So,
so reasonably priced, strong business fundamentals.
Yep. So EXP is a stock that, you look probably a year or two out, should be trading back above $100 a share.
Nice.
Just a company I've admired for a long time and waited for it to come down in price. And I think now you get it at a pretty reasonable level. Again, I think potentially you could see a little bit more downside if you get some bad economic headlines, but overall, longer term, this is a company that, I really like and think they grow earnings over 2 to 3 or 4 or 5 years.
So this one's down 50% off the highs. I wonder if does this kind of move with the housing stocks?
It does have some. They do have some housing sensitive business lines, but so it does somewhat move with housing, and but
do you know what the housing ETF is? I have it on here.
Well, there's a couple. There's like XHB and a few others. XHB might be the largest.
Oh yeah. There we go. Okay, so that one is down. Oh yeah, no, it's 35% off those.
Yeah. But EXP is more diversified than like your typical housing stock. Again, cement can be used in a lot of different things, from not only residential construction, but commercial, infrastructure projects. You've got, they also own some businesses related to like the shale oil. They serve like the frackers. They don't actually go and drill oil, but they provide like trucking and water services to a lot of the producers in the shale regions in the U.S.
Okay.
And those businesses actually have become really valuable because there aren't a lot of providers who provide those like takeaway services for sand and water to a lot of the shale producers. So,
Susan said, "Are they going to build the wall? build it out of concrete?"
I don't know. They aren't builders themselves, but honestly, if the wall gets built out of concrete, some of that will come from Eagle. So,
Oh man. Okay. Cool. So there's upside there too. There we go. There's a fundamental macro there.
I think I don't love retail, but I think Urban Outfitters is a cheap stock in retail, and you could get some bump in retail over the next month. Again, the MasterCard spending data showed that especially the apparel subsector within retail in the U.S. had a really strong Christmas season.
Oh, interesting.
And Urban Outfitters trades at about I think 11 to 12 times this year's estimated earnings. Have a really solid e-commerce business. They have a really clean balance sheet. In fact, they have $600 million of net cash on their balance sheet. So URBN, Urban, I think that is a stock that could be up 50% this year.
Nice.
But it will be relatively volatile and probably, trade somewhat on macro headlines.
Yeah, this has definitely got a big range. Let's see, last year or 17, so it's got support around $16. Been making higher highs, sitting kind of mid-range of this big volatile. Yeah, that's a lot of volatility.
Yep.
Did you have a target in mind for this, or have you run those numbers yet?
I need to get tighter bounds around my targets, but I think that is probably a $50 fair value stock.
Okay.
So it doesn't have as much upside as what I'd normally like to see.
Yeah.
But again, if you wait on this and if you get the right confluence of macro factors, you might be able to buy it in the low 20s, and then I think it gets a lot more interesting there.
I would like to. Yeah, that would be nice to be able to get closer to this kind of market structure support.
Yeah, it's nice to get some of these comments with people that are much more oriented towards technical analysis, because I think the combination of fundamental and technical could be really, really useful here.
I agree, man. I'm looking forward to the chat channels too, because Nikki runs a lot of the technicals on top of fundamental, and she comes up with some really good ideas too. So We'll all be in there kind of talking it out.
Yep. And maybe, I continue to like Twitter. I'm not sure. I don't know that the upside is there at today's prices. Mm-hmm. But I'll talk more about that in probably other shows. Box, BOX, is a stock that probably gets bought out in the next 2 years. Mm-hmm. Again, I think you got to be patient on it. It is trading at a pretty reasonable valuation, at least on a price to sales basis. But
who's a buyout target for them?
Well, I think Salesforce is probably rumored to be Salesforce or SAP or like a larger cloud SaaS provider.
Yeah.
So Box sells into the enterprise. So any enterprise SaaS players are going to be Microsoft. They also have pretty tight partnerships with. Microsoft could easily be a suitor there as well. Mm-hmm. Really well revered CEO and Aaron Levy. Really like the guy. He seems to know what he's doing, but it's just a consistently growing SaaS business with lock-in with its enterprise customers. Yeah. So, I'd like to see the share growth stop. Like I'd like to see them stop issuing so many share options. But, other than that,
are they? You think they're trying to get to profitability this year, and then maybe?
Yeah, and they're getting pretty close now. So I think this could be the year where they show profit.
Nice.
And yeah, I think they're a buyout candidate, but again, you probably want to be patient. If you can get that in the low to mid teens, then it becomes really compelling.
Cool.
And then what else? I guess Micron is a stock that don't chase. It's very cyclical, but trades for like 5 to 6 times this year's estimated earnings. It's a business whose industry is really consolidated. And so there are only a couple major players in DRAM and NAND memory now. And they were set to earn, I think, like $12 a share at the top of the cycle. This looks like their markets, its semis are weakening a little bit right now, but which is why you don't want to be aggressive in buying it today. But they're going to buy their own stock and reduce the share count. And when the cycle turns, they're going to be able to earn $15 to $20 a share, which means this could easily be $100 to $150 stock in like 3 to 5 years.
Oh, wow.
So I'm just being very patient with Micron and trying to like accumulate on, I actually bought some, I think around $30, back around December 24th or so. Sub 30, I think you start to accumulate it, but again, just not chasing because of the cycle. You probably see a little bit more downside this year in the stock, but again, I think $100+ stock,
longer term play.
Yeah, longer term.
Nice. Yeah, if you could get it in between like $10-15, that'd be nice.
I mean, $10, I would probably put, probably take equity out of my home and get involved.
Credit cards, man.
It'd be like 1 times 2022 earnings or something. It'd be like a crazy price to get.
Yeah.
Cool. So yeah, it's probably a good place to stop for today. I've got a couple others on the watch list I'm keeping track of, but we can talk more about those.
Yeah. Yeah, sounds good. And next week I'll kind of pull back and let you drive the ship. And, I kind of wanted to do, I guess, kind of a little bit of a guided thing today with everybody to kind of introduce you. And, guys, as you have questions, which I'm sure you will, just let us know. And we're going to be building out the members area and obviously the chat channels. And so a lot of this stuff will start to become more clear once we post this stuff and you get to watch the intro videos and kind of, learn through hearing Travis talk about this stuff over the course of a few weeks. So,
someone was asking about GE. They said 3 times now, so I better.
GE. Cool.
Well, yeah, I haven't. So GE is pretty complex. They've got a lot of different business lines, and the balance sheet is pretty convoluted. So I haven't worked through it yet. But I mean, I will note, some news on it. Like there was a rumor that Apollo is going to make a bid for their aircraft leasing business at a really high multiple. So that would be very good for GE. I'd be shocked if Apollo bid at the level that they were talking about, but if that happens, that could potentially turn the ship around in GE. But it's a pretty complex one to analyze. So I don't have any thoughts today in terms of what I think it should trade at, but I'll try to dig in some more on it so we can come back and talk about it.
Would you put this in the same category as like the Apples and the Googles of the world and kind of the ones that you stay away from?
Yeah, probably, but never say never.
Yeah.
Yeah, because there probably is some opportunity, especially because they have a capital structure which is fairly convoluted. Like they've got different types of debt securities in addition to the equity, and so potentially there might be some funky stuff to really go and look at and take advantage of if it sells off again. So yeah, I probably do need to do some work on it. But again, there are thousands of people that have looked at this 10 different ways. So
yeah,
I am not smart enough on it yet to really be able to tell you where it's headed.
When you guys were in the fund, would you guys just try to avoid these types of like really, really competitive stocks altogether? Or was it like if you saw something like a huge edge?
Yeah, it's unusual. Like, especially with mega caps, it's they're so widely followed and analyzed, and everyone's done deep work and has models that like the chance that you're going to get an edge is pretty low.
Yeah,
we have sweet spots in like the smaller and mid cap stuff where there's probably a lot better growth potential in companies that are smaller, but also there are far fewer people following it and investing in it.
Makes sense.
Yeah.
I mean, kind of those like mid caps where there's a good story and it's not on CNBC all the time.
Exactly.
And then like if you can get in before the news hits and the hype cycle starts, like
yeah,
that makes sense.
And GE also doesn't really meet the criteria that I was talking about earlier, where I'm looking in this type of environment for companies that have pretty clean balance sheets.
Oh yeah. So you're, because of, I guess, the global risk and like, the debt cycles like Dalio talks about, like that's what you mean by looking for like clean sheets.
Yep, exactly. Yeah. In the financial crisis, I would go look at this kind of stuff, or I would even go look at like the debt on this kind of stuff because it was trading for pennies on the dollar. That's a type of situation where I would go do the work and dive into something like this where, Bank of America at $4, for instance, so when it was trading at like 0.2 times price to book, that is a time when I'll go look at the mega caps because there's forced selling, there's serious opportunity. And even though lots of people follow it, people are being stupid and just selling it irrationally.
Yeah. Cause they think, they have, this was like such a crazy 6-month period.
Yep.
God, I'm just thinking back to all those days, like waking up and watching CNBC and I don't know.
Yeah. Some of I've been watching Deutsche Bank because I think it's got a similar trajectory as Bank of America did then.
Yeah. Rocky has been talking about this one quite a bit too. I don't know if he's still holding it. But, downside risk.
It trades at basically similar level to where Bank of America did from a valuation perspective when Bank of America bottomed.
Yeah.
And if 0.2 times price to book, which is anything lower than that typically signals near-term bankruptcy risk.
Yeah.
Problem is Deutsche Bank is like the largest bank in Europe, so bankruptcy really shouldn't be on the table.
Yeah.
Otherwise, we're all
bigger problems.
Yeah, we're all in trouble.
Yeah. Nick says, correct me if I'm wrong, but I believe there's a lot of risk around GE with the debt, SEC investigations, suspicions on their accounting stuff.
Yeah, I just, I haven't done the work on GE to really have the informed opinion yet.
Cool. All right, cool. That's probably a good place to stop it, guys. We've been going for a couple hours, so look out for the email with the recording and access to the videos in the members area. And then we're going to also this week launch the new chat channels and start throwing some information in there. And yeah, kind of a really good way to kick off the year here.
Awesome. Really enjoyed it, y'all.
Sweet. Thank you guys for sticking with us. And yeah, we'll talk to y'all soon.